It's Jeremy Williams with the Bannock Real Estate Group, and I just want to let you know we put together these videos because it's really important to us that we get relevant, accurate information into the marketplace as the market changes so you can make the best decisions. If you like the information we're providing, please subscribe. It makes a big difference for us. And then also, if you'd like to see a certain video about a certain topic, make a comment. We'd love to hear from you. With that, let's get into it. Hey, it's Jeremy Williams, the Bannock Real Estate Group, and thanks for joining us. If you've been watching our videos, you know today I get really excited about what we're going to talk about today, and that's the real estate market report. And today we're going to get a lot deeper depth than we have any other time. And I'm actually going to be sharing some of the data and some of the charts that we use to track the numbers day in and day out, so you can get a better idea of first where we're going, where we've been, and where we're going to go next. So I'm excited to go through it because really it's a tale of two markets. When we look at last year alone, we got first half versus second half, almost completely different markets in some ways, and get an idea of what does that mean to us. And most importantly, we look at history to help predict the future and what indicators we're looking at to help make those decisions. So here's some of the things we're going to go over. We're going to start with absorption rate, historical yearly sales over the last 15 years. And then we're going to get into last year, list of sales, absorption, sales. And then last, most importantly, what does it tell us about what we can expect in 2023 in our real estate market? So if you don't know who I am, I'm Jeremy Williams, the Bannock Real Estate Group. We've been in business for over 20 years. And since the day I got into business, I've been tracking the real estate trends. What I've learned is that if I follow the data, we can make informed decisions before the market corrects, or you read about it in the paper, because by that time, it's really too late. So we've been watching the numbers for over 20 years, and some of that data I'm going to share with you. And we've also been involved in that time period over 1,000 transactions. So we have a lot of experience to how negotiations are happening, how the negotiations happen in different markets, what opportunities, how to negotiate a contract in a strong seller's market, or how to negotiate a market in a strong buyer's market. All those things come into play. It's not like a one size fits all that you can put one standard practice in any market and hope that works out. And then also, we've been a part of a lot of different markets. So we got in at a great market. We certainly went through a recession, and really been, how that's helped us prepare for the up and coming markets and seeing the opportunities is going to be really important. So we're going to be going over supply and demand, as well as other algorithms that we use to make these decisions, and focus on the leading data that will affect us in 2023. Because one thing we find is the data is ahead of the headlines. And we got to be careful watching headlines, because headlines don't usually tell the truth. And the reason they don't tell the truth is usually one of a couple reasons, but they tend to focus on the historical data. So if you went through a couple slow months, but the market's picking up, that's not necessarily in the headlines. So we're going to pay attention to, why some of the headlines aren't telling the full story. And that's going to be particularly true in our Missoula market and Western Montana markets that have low numbers of data. They can be skewed up or down very easily by a couple outliers. And so we're going to pay attention to that and why we should be looking at that over the next year to help make a smart buying or selling or investment decision. So I love the data. After we go through this, if you're interested in getting our report that we send out, I'll be showing you an example of what that looks like later in this video. If you're interested in different types of information, don't see what you're looking for, we really do have a lot of data points that we're not going to be talking. It just takes too long to go through everything. But if there's something you think that would be helpful for you, please reach out. You can always reach me at jeremy@bannockre.com. or 406-926-6767. We'd love to hear from you. I love to talk about the market, trends, demand, supply, whatever it might be. I geek out over it. So please reach out, and hopefully we'll be able to help you out. So with that, let's just get started. this first graph that I have for you is really what we call absorption rate. Now, it's good. This absorption rate trends since 2006 and actually compares the absorption rate versus the interest rate. So if you haven't been watching our videos, absorption rate, I really focus this as one of the main indicators of where our market's going, because it really determines supply and demand. Basically, how many buyers are in the market versus how many sellers, and if there's more sellers than buyers or more buyers than sellers. So how absorption rate works is, let's just get an example. If you had 100 homes for sale and 10 homes sell every month, it would take 10 months to liquidate all inventory, right? So you'd have 10 months of supply. It's not days on market, but you have 10 months of supply before all homes will be sold. And that really determines if it's a buyer's or seller's market. So in this graph, if we look at it, this gray line right here represents the 6 months of inventory line. As per the National Association of Realtors, if you're between, say, 5 and 7 months of inventory, you're considered what we call a normal market. Now, a normal market to me is if you're a seller, you can get a good price for your house, and you can find a good replacement relatively easily. So if you're selling your house, buying another house, it's a pretty smooth transition between getting a good price and finding something of good value on the other side. And it tends to be an easier place to make those transitions. If you're above 6 months, it's a buyer's market. If you're below 6 months, it's a seller's market. And of course, the more extreme you get, the more extreme the market is. So for example, if we're looking at 2011 and we're looking at 15 to 16 months of inventory, that's an extreme buyer's market. And it's something that we need to pay attention to. What that means is there's a lot of homes on the market, buyers have negotiating control, and there's just not as many people purchasing a home. Now, on the other extreme is if you look at, say, January of 2022, just a year ago, I think we were down to like 75 houses for sale, and it was an extreme seller's market. So when you put your house for sale, there was bidding wars, hundreds, sometimes even $200,000 to $300,000 over asking price in some extreme cases. And there'd be 40, 50 showings and sometimes 20 offers, because there's so many more people looking to purchase than there was looking to sell. And so you can see the difference between these extremes. And within these years graphs, we could also see trends. So no matter if it was a seller's market or buyer's market, you can see these yearly trends within its own market. And what it typically is in January, there's usually less houses for sale. In May, we see the most houses for sale. So you see this yearly trend, January, May, January, May. And then for the last couple of years, it actually wasn't as extreme because the winter markets were actually pretty active. But especially in some of these more recessionary times, there was big extremes between the spring market and the winter market. And so we look at that as opportunities too. So if you come to me and you're like, hey, I'm looking to sell my house, is now a good time to sell a house? These are things that we're paying attention to, because just because it's the winter months doesn't mean that's not a good time. It usually shows that there's less competition than you're going to have in the spring months. There's going to be more buyers and more looky-loos, but there's also a lot more competition. So we look at these different indicators to help us make decisions. One of the things that I wanted to focus on is this line right here. This orange line is what interest rates have been since 2006. And you can kind of see they've been under this under a 6 interest rate going back to 2009. So that's kind of what the public's gotten used to. But previous to that, 6% interest rates were pretty common. In fact, if I extended this graph on, you can see, 6.5 for years, starting early 2000s, was about the norm. So we're about back to that market right now, which for a lot of us have been in the business right now, it's a rate we're used to. It's more of a normal market. These rates that we've seen over the last 5-10 years have been more extreme to the benefit of a buyer, but they've been more extreme than what history predicts. One of the things that I've been looking at is, okay, what are the tolerances in our market when when it comes to supply and demand, I think it's greatly affected by affordability. And we all know prices have gone up quite a bit over the last few years. So as prices go up, when rates are low, it still creates affordable house. But when rates and prices go up, then it becomes unaffordable quick. So one of the things I'm tracking right now, if you follow this rate line and you follow these lines right here, this would be our market absorption rate trending towards a normal market. It took a big jump when we got to about 5.5 interest rate. And that's one of the things I'm tracking of being like our affordable index, if that's what you want to call it. Meaning like for today's prices at a 5.5% rate, the market's still is still appreciating in some cases. When we start to get the 6-7% rate, then our market's pulling back because it's just simply not affordable to the general public. And so as we got up to 7 months of inventory, or excuse me, 7 month try this again. When we got up to over a 7% interest rate, we saw spikes in inventory, and you'll see that on the next graph as well. And that's actually cooled off a little bit. I think if we stayed up at 7, you would have saw the absorption rate trend more towards this normal line faster. But over the last couple of months, we've actually seen that rate come down a little bit. I think if we could get down to a 6 rate, but ideally 5.5 is that target for today's prices, that's going to keep our market moving, normalizing, and keep our market healthy. So to speak. So that's one thing that we're really watching for. If rates spike up again, the 7 or more, well, then I'd expect that normalizing market might even push into the buyer's market if that goes on for too long. And there's a couple things that might make that hard to do. We'll talk about as we go through here. But rates is something we're really paying attention to because it affects affordability, but so does price, right? So if rates stay high for a long enough time, it stands to reason that the prices are going to start to decrease to get to that affordable range too. And so we will see a little bit of that over the next year, and especially in certain price ranges. There's some that are going to be a little bit more secure than others, but we will see those changes happen. So if the rates come down in a reasonable time period, then the prices are going to stay higher. How it works is one thing we want to pay attention to is why are rates high right now? Why did rates go from essentially 3.3 to 7.3 in just a couple months span? Well, what I believe is the reason rates are high is because they're trying to use housing to curb inflation. So they're trying to purposely slow down the market. I think part of the goals is if they could get the market to come down 5 to 10% and actually slow down the market to help curb inflation. As inflation slows down, that's why we've been seeing a little bit of a positive effect in rates, is because when inflation slows down, the rates have been coming down a little bit too. And so if we believe that the government's using this as a tool to slow inflation, it stands to reason if inflation numbers come down, then sooner than later, we might get back down under that 6% rate. So that's something we're really, really paying attention to as we get into 2023. This is same information, just presented a different way. What we have here is our active listings. And you can see those years where we had the high absorption rates, the buyer's markets up here. I mean, I think at one point we were 12 to 1,300 homes on the market at any given time. Why I say it that way is right now we still only have about 200 houses for sale out of 80,000 people that live in the Missoula area, right? So 200 homes for sale here is still extremely low compared to the 1,400 homes we had in the past. Even if you look at the earlier, pre-recessionary times, and it was still a little bit of a seller's market or a normal market. I mean, even then you had 400 or 500 homes on the market at any given time. I'd say, we probably should have 400 or 500 homes on the market right now that have a healthier market, because it's, again, still very much a seller's market, trending towards a normalizing market. But one thing I want to watch out for is if you watch, I'm just going to go back to this previous graph. If you watch us going into a buyer's market and coming out of a buyer's market is relatively short time periods. So that's why we're really watching this data, because if we went from January 2010 to January 2011, that's an extreme change from a strong seller's market to an unbelievably bull buyer's market in just a year's time. And even if you took a 6 months time, that changed fast. Now, there was things that happened. We lost the subprime market, loans changed, people were overfinanced in their houses. Very different time than today, but that created a huge impact in a short time period. Now, we also look at this, let's just take January of 15 to February, March of 15. We went from a strong buyer's market all the way down to a strong seller, or a normal market, but even trending towards a seller's market. We saw a blip, and then we've been at a strong seller's market. So when we see market changes, there typically isn't a gradual change. We tend to stay in a market for a while, usually stronger on the seller side or the buyer side, and then we shoot right up in the buyer's market or shoot right down into the seller's market. So that's obviously, as we head into this year, that we're going to be watching for. If all of a sudden inventory starts going up like crazy, then we might just pass through that normal market and end up in a buyer's market. And there's a couple indicators that we're watching of that, but that's going to be the big thing. It's going to be very telling over the next 2 to 3 months. So the blue line is active listings. We also track the new inventory coming on the market, the pending inventory coming on the market, and of course this yellowish orange line is the selling, the homes that are selling each month as well. And what's been interesting is certain market segments, no matter what the market is, has stayed relatively consistent. Now, there's some markets that get hit hard. We'll be talking about that later. But for the most part, since 2006, we've seen this relatively same number of homes selling. It's just how many homes are on the market at any given time that affects pricing of those homes as well. So you can see rates went up. We talked about rates going up in May. And this gives you a better show of how inventories increased since May. But over the last 2 months, if you can see that, rates came down and that stabilized a little bit, because that was a pretty dramatic increase, and then it stabilized a little bit as our rates started going down to 6, which leads us to believe that if we could get to a 6% rate, it should stay relatively consistent, but with the goal of being at 5.5 or lower is going to add some more affordability to our marketplace. Next, this is actually one of the most interesting graphs out of all the numbers that we've been trending over the last few years. And the reason I think it's interesting is it's really tracked since 2007. So about the last 15 years, how many homes in Missoula sell every year? So if you look at 2007, we had 1,445 houses sold. We hit a recession and then we dipped under 1,000 homes for a few years. And then since 2013, we've been roughly 12 to 1,500 homes every single year. And then down to last year, which was another, historically low year of sales, to 1,024. Why I think it's so interesting is because during this time, our population has increased quite a bit. However, the number of sales stays relatively the same for 15 years, which I think is shocking. Last year, it's the tale of two markets. For the first half of the year, very low inventory. There was a lot of buyers that wanted to get into homes, but there wasn't enough to actually sell. So it was a low sales time over those 6 months. The second 6 months, complete opposite. There was still a low amount of homes, but demand slowed down too. So a lot of homes, when rates are going up, people tend to step back and make sure they're making a smart buying decision. So it just ended up being a very low number of sales last year because of those two completely different factors. But over the last 15 years, I would have expected to be over 2,000, 3,000, 4,000 homes during this time period with the population increases. Certainly during like COVID times when people have been talking about all the people moving into the area, and that's simply not the case. We've had same number of homes relatively. You can usually predict between 1,000 and 1,500 homes, but usually 1,000 to 1,300 homes seems to be the average. Now, there's a couple of reasons why I feel this has happened. I mean, one of them, let's just take the university, for example. I know when I was going to school back in 2000, And when I graduated in 2001, university enrollment was 15,669 people. Like in the late 90s, early 2000s, the university was huge. Right now, enrollment's only 7,200 people, or just over, and that's half the size. Imagine what our market would be like if there was 7,000 to 8,000 more students taking up rentals. Presumably, some of them are going to be buying houses. Well, let's be honest, they all need a place to live. They all have to be displaced somewhere. So what I think's happened is, as our population increased, our student population has dramatically decreased. That's part of what offsets who's buying homes. So it's kind of more averaged out at the same number throughout that time period. Now, I know the university is growing, so that's something that we want to pay attention to over the next 5-10 years. If our population continues to grow and our student population continues to grow, it's really going to put a lot of pressure on our housing. And what's that going to do to supply and demand? So certainly something to pay attention to if you like tracking these numbers or seeing where we're going over the years. So I put together this graph, list the sales price percentage, and it's something that I track on a weekly, but certainly monthly basis of what's going on, because it lets me know if the market is appreciating or depreciating. It's one of those leading factors. So obviously, if we look back at the beginning of the year, this is January, is exactly a year ago. Our average list the sales price was 102%, meaning that on average, we're selling houses for 2 to 3% over asking price. Now, let me tell you what these two lines are. The orange line is the list the sales price, but the blue line is the original price. So how this works is, this is what was originally listed for, and that's the list sales price, what it was originally listed for what it's sold, right? It gets a little confusing. However, if there was the orange line takes into account the percentage that it's sold, list the sales price based on the price that it was listed at the time it sold. So for instance, if there was any price reductions, the orange line is going to be the price reduced and then the list the sales price. The blue line is going to be just based on what was the original price, what did it end up selling for. So if we got that, first part of the year, you can see those two lines stay pretty close, meaning there wasn't a lot of price changes happening in those markets. And in fact, if you ask me, hey, Jeremy, what was the best time to sell my house to get the most amount of money? Well, it was May. That's the top of the market. The unfortunate part about people that are trying to time the market is we usually don't know that it's the top of the market until we're past the top of the market. So May was the best time to get the most money for your house, where we experienced 107% list to sales price last year. Now, remember in May, rates went up, inventory started to slowly increase, and as rates went up, our list to sales price started decreasing. And in August of this year, right around that time where we started seeing the 7% rates, that's where we started dipping under 100% list to sales price. And so during this time, everybody's selling their house for the most part over asking price. Starting in August, you started getting about what you were asking for. And over the last couple months, we've seen 96 to 98% list the sales price. We see a bigger gap here, which means there's a lot more price reductions to get to that list the sales price. But it also is at 96, 98%. Just so you know, when I've been tracking these numbers for 20 years, that's more of a normal market. That's not outlandish. That's more of what we would expect to see in a normal market. So it isn't, in my opinion, it's normalizing. If we continue to see this go dramatically down, well, then we're starting to lose some value in our houses, and we want to pay attention to that. Of course, the last 2 months, again, rates have normalized a little bit. List the sales prices have normalized a little bit as well. But it usually is an indicator of where a market's going. When we're in this market and we see over 100%, we know we can list your house for more than your neighbor's house just sold for and get more money for it. In these markets, We just have to be a lot stronger on our price based on what the data is telling us. We're not going to be able to mark it up ahead of the market. We're going to have to put the price at a more firm price for what today's market is actually. So that's something that we want to watch for. In my mind, there's a couple stages to price reductions. We're going to talk about price reductions for a second. And so when we see these price reductions or we see these lower list of sales prices, there's a couple tiers that I watch for. Tier 1 is overpriced homes stop getting activity and have to do large price reductions while the rest of the market is still going strong. And so I think that's mostly what you see here. Those people that tried to list their house at crazy prices, hoping somebody will buy while the market's changing. It's usually those overpriced houses that get affected first. Tier 2, days on market on upper end homes will increase and they'll see more dramatic price reductions. So some of these price reductions, this isn't 96, 98% list the sales price across the board. It is, but normally what's happening is $1 million homes, $700,000, $800,000, $900,000 homes are seeing the hits first. And while there's a certain other part of the market, and I'll show you this later on, is actually still going really strong. So that's tier 2 that we watch for. Tier 3, activity slows down. Price reductions start at the high end of the market and gradually work their way down. And that just depends on how long we last in this market. So right now, the $1 million homes are getting hit. The $800,000 to $900,000 houses are still getting hit. But some of that market below that is still going strong. Now, if that continues, it's going to hit the 6 and 7s and eventually a little bit the 3s and 4s. But those markets, even in a hard market, tend to still do well. When you're at that bottom quarter, bottom half in price range in the market, they tend to still do good even in some slowing market conditions. And then really, that's how we've hit the 4th tier of this progression. And when I say tiers, like this happens over the course of time. The lower and mid market continues to sell, but it's finicky. All of a sudden, you can't just put on a house at $350,000, $400,000 and expect it to sell right away. It's still finicky, but there are buyers there looking for value. And a lot of times in that time period, if we get to that 4th tier that we experienced during the last recession, the priorities of a buyer change. It becomes more of getting into a stable place to move into for living conditions or to move your family into, instead of does it have granite countertops, does it have the max amount of square feetage, how big is the backyard. It becomes more of a place to live. And when we start to see priorities change like that, then we know we're also in that 4th tier where it is a good market, but it's finicky and you can't miss you can't miss it. Where we often see this the most is in new construction. When we're in a market like we were in previous to May, a builder could probably pick a plan off the internet, build it. Somebody's going to buy it just because there's not a lot of options. We get down to tier 2, 3, and 4, and all of a sudden, if you're a foot off on a wall, you're not quite the right livable square footage, you've put the wrong finishes in the house, it could be the difference from a house selling right away, even if it's in the right price range, or staying on the market for a long period of time. So this data becomes really important, especially if you're building homes or making investment decisions. So right now, I think we're in that tier 1. I'd say the upper part of the market's getting hit a little bit. The overpriced listings are getting hit, and we're starting to see things normalize a little bit compared to where we've been the last 2-3 years. So I think we're phase 1, tier 1, tier 2. The negative effect of the change in market will really be determined by how long we stay in this market before rates either come down or prices come down and we get to that affordability range. So right now, if we've been in this market for, let's just say 6 months, right? If that 6 months turns into a year, 2 years, 3 years, that's how we start working our way down from tier 1, tier 2, tier 3, and tier 4. I mean, tier 5 is, that's where we have foreclosures. That's where we see, a huge amount of inventory. Maybe we get up to those 1,400 homes a year type markets. Right now, we're still far from that, but we're being cautiously optimistic in a lot of ways. But really, we're going to know a lot more in the next couple months. Okay. So one of the things that I also track is the previous graphs on absorption rate I showed you was for the last 15 years. What this is absorption rate for the last year. Kind of same information that we talked about. This is that normal market, that 6 months of inventory. You can see this time last year we had 0.75 months of inventory. It essentially means that every house came on the market sold in less than a month. And we had to refresh the inventory on a monthly basis. Doesn't mean everything sold, because there's some homes that are extremely overpriced, still weren't going to sell. But for the most part, essentially it means there's almost zero inventory at any given time. If you were looking to buy during that time, it was incredibly frustrating. There wasn't a lot of homes, and the homes that did come up got a lot of activity. We go into May, top of the market, rates start to change, inventory starts to soften up, and now we're actually coming down a little bit. We talked about rates coming down. We see it trending a little bit back down towards a more extreme seller's market. In my experience over the last 15 years, 2 months of inventory is extreme seller's market still. We're still in a seller's market, but I can tell you, if you're looking to buy a house last year compared to this year, it is a much easier, pleasant experience than we've had in the past. Okay. So a question I pose out there is, if demand's lower, how come there's not more inventory on the market? Typically when demand's lower, there's more inventory, and certainly not a seller's market. This is unique for me, where we get into a situation where there's a seller's market actually feels a little bit more like a buyer's market, because the houses that are for sale aren't getting as much activity as you expect. They are still selling, but not nearly like they were. And I think that a lot of that comes down to the people that bought their houses for the last 3 to 5 years. I think for one, a lot of people have got into their house at an extremely low rate. If you're at a 2 or 3% rate, your mortgage payment is probably such that you're not going to sell, because if you did, even if you wanted to get into a rental, you're probably paying more for that rental than you are for your mortgage payment. And I think because of this is going to keep people in their houses for maybe more like 10, 15, even 20 years, compared to when I first got into business in 2003. I think the average was about 5 years. So people were turning over houses pretty quick. And with these low interest rates that they're locked into, I think they're going to keep that going for quite a while, not have to sell if they absolutely have to. Now, the other side of it is most homeowners that have owned their house, even if they bought it this year, have tens, but maybe even $100,000 to $200,000, $300,000 more if they've owned it for a couple of years of perceived equity that they have in those houses that they're really going to hold on to. And so you're just not going to put your house on the market because you get scared. You're probably going to find a way to hold on to it as long as you can, even when times get lean. So I do expect homeowners to live in houses. I don't see a flood of inventory come in the market at this time. Obviously, if things in the economy, because we also have to consider not just housing, but gas prices, food prices, just the cost of everything in our lives playing into effect. But I don't expect a huge flood of houses coming on the market unless it's still something this drags on for a long time or something dramatically changes. So this next graph, I thought this was interesting. This is going to go back to the beginning when we talked about the headlines being bearish on home prices and why it doesn't necessarily tell the whole story. If you look at this graph, this is for 2022. And what it indicates is how many homes sold in each price range for 2022. And I can tell you there's a huge outlier here, and that's the $1 million homes. Okay. The reason I say it's a huge outlier, so previous to 2019, the most $1 million homes that I'd see in a given year are less than 10. In fact, there was a lot of years that it might have even been 1, 2, or 3. And so last year, if you look at it, I think this is about 56 homes that have sold last year over $1 million. Now, that's a dramatic change when 2019 previous to go from 10 homes to last year, 2 years later, selling 56 homes over $1 million. Now, what that's done though is when we look at data, and I'll show you this on the next slide, but when we look at data, it's really skewed our average median price, our average sold price, our median sold price are really skewed by this number right here. And the reason I say that is because when we look at just about 1,000 homes sell per year, $56 million homes changes that number pretty dramatically compared to if we were in a market where if there was 5,000 homes that sold and now there's $56 million homes, it probably doesn't make much of an impact. When we live in a small market with small data changes, a couple outliers here or there can really change the data and might give us a false representation of what's really going on. So we got to be careful that we're making a right decision. The reason I think we're going to see reports on bearish markets for the Missoula market is because I think this market, I anticipate this normalizing. I think 56 homes is extreme market, and a lot of that was because of low rate. You know, $1 million home wasn't as expensive at a 3% rate as it will be at a 7% rate. So if this market gets cut off and goes back to normal, say 10 homes a year at the $1 million range, well, all of a sudden what you're going to see is, I can't believe how fast the medium and average sold price how low and how fast it's come down. Well, the reality is it really hasn't come down. It's just been skewed by this market. I expect these markets, these are the 3 through 7 price range. I imagine this market is the core of our Missoula market. I expect this to stay strong for the foreseeable future. So, I mean, this is really the data that we need to be paying attention to, but just know that it will be skewed by some of these outlying markets that have been created over the last couple of years. And I want to make sure that we're making smart decisions based on actual data and not the wrong or even national data even that would give us a false representation. So this is an example of a report that I put together, and this is just part of a monthly report that I send out. Again, if this is something that you're interested in, if you like to watch the numbers, maybe it affects you on the investment side, maybe you're thinking about buying, thinking about selling, let me know. Again, you can reach out to me at jeremy@bannockre.com or 406-926-6767. We'd love to hear from you. But what these charts are is, first, is this a monthly report that I put together. So in December of 2022, these numbers actually represent a whole year's of data because I do a 12-month rolling report. So in December, we got January through December, and for all of last year. So what this looks like, actually, I was saying that there's 200 homes for sale. There's actually 185 homes on the market this month. And here's the price ranges that those homes are on the market for. How many or less homes are on the market compared to this time last year. So we get some idea of the trends of a decrease in emerging market or decrease in markets. Right now, the average list price is $800,000. Again, part of the reason why the average list price is $800,000 is because you got, 36 houses over $1 million. That really skews the data of the other houses that are for sale. So if you took out these 36 houses over $1 million, that average list price would be considerably low and more normalized. It wouldn't be nearly as scary as a number. So if you're not $1 million buyer, it's okay. There are still plenty of houses for sale. I mean, here in the range of 250 to 300, there's 11 houses. 450 to 500, there's 14, and these are coming off the market pretty regularly. And the same thing goes for, it's part of the reason that data, of the median market, it's not skewed quite as bad because it's the middle number, meaning half the homes are priced above 600 and the other half are priced under 600, but it is still skewed because of some of those outliers. Pending right now, we have 42 homes pending. You can see the price ranges that they're pending at. And then right now we've got 59 properties that closed just in December alone. So 59 properties in December historically is a pretty normal number. I think the last 2 years it's been considerably higher. But we typically don't see, huge numbers in our marketplace. And I'll, actually, if we look over here, This is representative of the sold, how many homes sell per month at any given month. And if you look at the historical trends, I mean, I think I saw one month in the last 20 years that got up to 178 homes that sold in 1 month. But usually on our top months, it's 100 to 120 houses. And then our maybe more seasonal markets or winter markets, 50s, 60s, 80s are still strong markets. The worst I ever saw was in February a couple of years ago, and I think there was maybe 30 homes that have sold all month. Extreme weather market kept a lot of people inside. Maybe some of you can remember that late February storm we had a few years ago. But in general, if you have a month where 66 houses sold and 3, 4, or 5 of them happen to be $1 million plus homes, it's really going to skew your data. And that's what we're paying attention to, is using real data. So we track the odds of selling your home, what price ranges are selling. And how this works is it goes back to absorption rates. So it takes into effect the absorption rate. If you're in the red, that's a buyer's market. If you're in the yellow, that's a normal market, average market. If you're in the green, it's a seller's market. So right now it's pretty telling. And now this is just based on December stats. It's not for the whole year, but I run the absorption also on a monthly basis. But there's a clear market here between 300 and, well, even up to 800. That's still very much a seller's market. Now you get over 800 and it's starting to soften up considerably, and it's becoming more of a buyer's market. So when we talked about tier 1, tier 2, tier 3, you can see these are the markets that are starting to soften up, but we still have a really strong base of a market in Missoula. And it's still very much a seller's market. So we're paying attention to that too as we head into 2023. Over here, a couple data points to look at. We have average sales price still increased 14.39%. So to put that in perspective, 2020 and 2021, we saw about 27 and 29% appreciation. I mean, if you had it means your value of your home increased almost 30% for 2 years straight, which is unbelievable. But even last year, even with our market slowing down a little bit, in general, actually, we're still gaining 15% appreciation, which historically is unbelievably high. I would say a more manageable level for appreciation is probably that 5 to 8%. That's something that can control. It means prices are going up, but not such a rate that the incomes of the general public can't keep up with. So I do expect that 14% to decrease even further. Probably, I'd like to see it around that 8%, 5 to 8%. I think that'd still be a really strong market, but that's obviously something that I'm watching throughout the year. It is a little skewed because it takes into account 6 months of really strong appreciation, and then it takes into account 6 months of, it's still saw appreciation, but it's certainly a lot slower. So as we get through the first quarter here, I think we'll start seeing that 14% get closer to maybe 10% or so as we go through. And of course, what we talked about before, we had 20% less homes sold this year than sold last year. How we use these graphs, if you're in one of these price ranges or a buyer or seller, it helps give us an indication of how we're going to price or negotiate for your home. What is the demand? What's the activity? How strong do we need a price? Could we price your house a little bit more and beat the market? Or do we actually have to price it a little less than everybody else because the market's coming down? And if we can get to that lower price, then you're going to sell faster and at a higher price, because some of those houses that are hanging on for a high price don't realize the market's coming down, and they're going to have to make a big jump later on to catch up with the market. So these are the kind of numbers that we use to make sure that you're either selling your house for the most amount of money, or you're you find the opportunities as a buyer. And these are things that I think a lot of other people aren't looking for. So it's really important. I think more than any other time in our marketplace, I'd say the next 2 to 3 years, it's going to be really important that we follow the data and understand what the data is telling us to make those smart decisions. So, I mean, we've gone over where we've been. We've gone over last year's numbers. What can we expect? What can we expect 2023? I mean, what does this all mean? Because historical data, it's fun for me to go over. But what's most important, how do we interpret that? How do we look at it for the future? Well, I think one thing we could expect if you're selling your house, expect less activity on your homes, but just know that the few buyers that are going through are most likely very qualified, and you should take all of them seriously. I also think that the negotiations are going to favor the buyers a little more than they certainly have after the last 2 years, where we've seen crazy negotiations for people trying to buy the house. Well, now it's normalized a little bit, probably more like a negotiation previous to 2019, where you can have an inspection, an appraisal, a normal closing time period, and you have some tools that you can put into an offer to help negotiate and make sure everybody gets what they want after the closing. So I believe the next 3 months personally are probably going to be one of the best opportunities that you have to buy a house than we've seen in the last probably at least 3 years, if not more. And the reason I think that is because there's a lot of people in a holding pattern, inventory is increasing, the buyers haven't all jumped into the market, and some of the prices have softened up. So I think that if you're looking for value, you're looking to get just simply a great price for a house, I think the next 3 months are going to be critical, because as spring, if we see a spring market come, then this market, because it is still a seller's market, could spiral out of control a little bit, and we could still see those prices increase faster. My philosophy, I got this from a lender. He says, hey, marry the house, date the rate. If we believe rates are high because it's curbing inflation, then we also believe that in a relatively reasonable time period, maybe that's a year, 2 years, 3 years, we're going to see those rates come down. So if you can get a good price on your house now and refinance later on, you're going to be in a really good spot in the future. So what are we watching? Over the next couple months, we're really going to be paying attention to list the sales price. Make sure that that number is kind of averaged out around that 98%. List the sales price, create a normal market. I do expect to see absorption rate over the next couple months trend towards the normal market. I wouldn't be surprised if we don't get towards like 5 months of inventory. Still a very manageable zone for our Missoula market, but we just want to make sure that we don't see a huge increase like we saw in some of those graphs in a short time period. Right now it is normalized a little bit. I feel confident about that. I really think that this first quarter is going to set the groundwork for the rest of the year. We're seeing new listings coming on the market, and we're getting activity on them. I think that's a great start. If these houses continue to sell as we head into spring, we're going to have a more normalized previous to 2019 type market. If inventory increases, but the sales don't increase after first quarter this year, well, then we're going to have to reevaluate the direction this market's going and have to make changes quick. So that's something that we really want to pay attention to as we go through. And, of course, the rates do. I mean, that's going to make a difference. If those rates come down, even if prices don't come down, I think we'll be in a good spot. If rates and prices come down, we'll be in a fantastic spot. But it's yet to be seen how that will lay out for the rest of the year. So, I want to appreciate, this is some of the information that we use. It's a little more detailed. You can see some of the graphs that we've been using. And I thank you for taking the time to watch this video. I hope you found it informative. If you have any specific questions or want to know how this plays out in your investment, please reach out. This is just a small example of the data that we use. We have a lot of other analytics that we use. We do market data on just about every marketplace in Western Montana. So if you're in Hamilton, Whitefish, wherever it might be, we have the data on it. We're tracking all these markets and can help you. We also have, you might not realize this, we do commercial. We track investment properties, we track developments, new constructions. These are all things that we can help you make more informed decisions. And two, you might not realize our research team also specializes in land development, new construction sales strategies, and master plan communities. So all different segments that we pay attention to that rely on strong data to make strong decisions and informed decisions for that matter. So again, I look forward to hearing from you soon. If you have any questions, again, you can reach me at 406-926-6767, or of course, reach out to me on email. You can email me at any time at jeremy@bannockre.com. That's BANNACKRE.com. And we look forward to hearing from you soon.